All right. Good morning, everyone. This is Tom Hegna. You know, military guy, so I like to start on time. I think you're going to find this webinar to be very interesting and very helpful. And if you stick around to the very end, John's got a special deal for you as well. Before I introduce John, just a couple administrative things. First of all, I would encourage you not to multitask. I mean, it's always, you know, tempting when you're doing a webinar to try to check your email and your text. Look, John's going to give you everything he's got for the next 45, 50 minutes, and I would just ask you to give him everything as well. The other thing is, feel free to ask any questions. There's a Q&A tab. There's a chat tab. I'll be monitoring both of those so John can focus on his presentation. And if you have questions, if you have comments, I will relay them to John, and we will also, you know, be free to take questions at the end, but please do that via the chat box or the Q&A. If for some reason those don't work for you and you still have a question, you can always send it to info@tomhegna.com, info@tomhegna.com, and we'll get it to John and we'll get you the answer. So let's get started. You know, I've known John Oldham probably for 15 years. We go back to my New York Life days. He's been in the business. He's been a top producer. He has now created a software system that is really incredible that can help people stay out of a lot of trouble when they're doing annuity business and that type of business. I don't know if you've seen the headlines lately, and John will probably talk about this, but, you know, MetLife got fined, I think, $20 million, and Fifth Third was in there, LPL, AXA, you know, Edward Jones. All these companies are getting sued because the transfers from one annuity to another are not filled out properly. In fact, you know, I think John will tell you some crazy statistics, like 70% of all the applications are filled out wrong or something. And so what John has come up with is a system that is, you know, almost foolproof to help you navigate these waters. So, you know, with that, I'm going to turn it over to John Oldham. He can tell you a little bit more about his background. And John, let's get into it. Welcome.
Well, thank you, Tom. I appreciate you having me today. As you mentioned, we do go way back. I think the first time we came into PASS was back, I think 2003, 2004, back in Wisconsin. And the first time I heard you speak, I was motivated by the way that you're able to use both data and facts and figures, but also the stories to captivate an audience. And I'm honored to be here with you today. I just hope that our connection stays strong for the next, like you said, 40 minutes or so, because I'm sure you're probably on an airplane or a plane, train, or automobile somewhere with the travel schedule. I want to thank you for your dedication to the industry. If it wasn't for you, I know there's a lot of guys like me in the industry that probably wouldn't be here today. So from bottom of my heart, I want to thank you for that. Again, the math and science that you've been able to use in our industry to lay this out in a way that not only advisors can understand, but clients in the field can understand as well, has been such a help. And I encourage anybody who's on this call who hasn't checked out these books to do so. Handing these over to your clients and letting them understand in their own words where this stuff comes from just makes your sales process so much easier. One thing that I've always related with you, Tom, is the way that you tell stories. And stories are so powerful because they create a concept or a place that everybody can identify with. And right now, my story for 2018 is, what's your plan for dealing with this? You know, people sometimes get complacent and don't realize where we've been and where we've gotten to at this point in time. But you know, that crash of the market that happened in 2008 is almost 10 years ago now. And we've seen this market go just straight up for the last, you know, 8-9 years to almost 10 years now. And we haven't seen any volatility really come back into the marketplace. Now that's starting to change. So this one chart here of being able to put this in front of your clients and say, listen, over the last 10 years, a blind monkey could have gotten you a really nice rate of return because the markets have done nothing but go up. What's your plan now? I mean, we're starting to see this volatility back. How are you going to deal with this going forward in the stock market, especially now that you're 10 years closer to retirement or 10 years further down in that line? And if the stock market isn't scary enough, let's talk about this bond market, right? The typical wisdom is the stocks are for growth and the bonds are for safety. But what about this? You know, the last 30 years, all of my career, most people are in the industry, their entire career has been interest rates going down. And the old bond teeter-totter adage that when interest rates go down, bond values go up have made bond market investing look overly good over the last 10, 15, 20 years. And now we're starting to see interest rates rise in an upward direction. So if we're at an all-time high in the stock market, which at some point has to come down, and we're at an all-time low in interest rates, and the Fed has already begun to raise those, I mean, what are we going to do? And how does this math work out to it? Again, Tom, the math and science that you've always put to it. This is a little bit old of a slide, but this is showing back when the 10-year Treasury was back at 1.4%, and the 30-year Treasury was at 2.25%. Take a look at this. If the Fed raises rates on the 10-year from 1.4 to 2.4, you know, that's a 1% raise in interest rates. That's an 8.84% loss in price of a bond. If you own a 10-year Treasury and you're getting paid 1.4%, that's like 6 years worth of interest that you lose in one day just by the Fed raising these rates 1%. And if you take a look at that on a Treasury, they raise it 1%. Now that's 19%. So what is your plan for dealing with this? Because the bond market could be just as volatile or even more risky than what we're seeing in the stock market. So how many of your clients really understand this? And I think if you can boil things down to a simple story about we've gotten here based on the markets working to our advantage, how can we deal with this going forward? Because if you don't wrap your mind around this and are able to relate this to your clients, I really believe that these next 5 years could really be the toughest years of your career. So adding value to your practice is what we're trying to do, is of giving you ways to be able to communicate this with clients in an easy way so they understand that we may need to look at things just a little bit differently. One of my biggest challenges over my career has been that little awkward moment that I'm sure some of you have dealt with yourself, and that's the working with a new client for the first time and trying to figure out how to do a fact finder. You know, I'm a relationship type person. I like talking to people and making friends and that type of thing. But that first step from the pleasantries to where you need to start getting some data out of them on how to fill out your fact finder to be able to add value to them has always been a struggle for me. You know, you don't really, in the real world, you don't talk about money and you don't ask those specific questions. I mean, it feels like a colonoscopy to me. So how do we go about getting this fact finder from clients and getting the data we need to help them? So I've created a process for me that I think really will help you as well. And we call this our AUM process. You know, every advisor out there is looking to add assets to their business, no matter what type of assets they are, whether it be an annuity or managed money or mutual funds or whatever it is. But we're always trying to add more assets under management. And I think that A really starts with adding value to your prospect. Because once the client feels you out a little bit and understands that you really are there to add value to their situation, like Tom has done for us for the last 15 plus years, now they're more than willing to give you all the information that you need to help them. So two of my, again, Tom and Van Miller, two of my favorite people, and what I've always learned from them is the phrasing, the masters of phrasing, the wording. And if you can word things right, people just open up and are willing to provide that information. So I want to start here with just learning how to use our data that we're going to show you in a moment here to get them willing to provide us the information we need to be able to do a fact finder accurately and then be able to pivot to our sale and then ultimately document that sale at the end. And here's how it's worked out for me. I'm from the Midwest, I'm from Wisconsin, and you know, the farmers in the middle America, people sometimes are a little tight-lipped about their money, the millionaire next door type. So I've always related to them by saying, Mr. Jones, you know, thanks for coming in today. I know you probably got to this point in your life by saving a few pennies, right? What type of investments are you experienced with? And when you ask a question like that, you're not asking, Mr. Jones, tell me every penny you got, where it's at, how much, who's it with, all these questions that make them uncomfortable, but just what are you experienced with? And they can say, well, you know, I have a couple mutual funds, or I bought an annuity, or I have this, or I have that. But again, it's a very non-threatening question. But from that point in time, now you know something to be able to form your conversation around. And whatever the answer that they come back to these phrases, then my next question to them is, Mr. Jones, that's great. Good to hear that you've saved a few pennies and you've experienced a few different types of investments. One question, can you tell me exactly how those investments work? And the reason I ask this question is simple. Most people just do not understand exactly how their investments work. The difference between an income rider and a cash value, or a front load or a no load fund, or all these different things, most people truly don't understand exactly how those things work. And trust me, this isn't a problem. I don't understand how anything under the hood of my car works, but to be able to let them comfortably understand that and communicate with you that they don't understand how those work is a huge process, because that opens up for us to be able to add value. And then the third question is, can you tell me exactly how much it costs you to own your investments each year? Because again, people almost never understand that. They don't understand what it costs them to own an investment on an annual basis. So once they understand that and they wrap their mind around that, they don't necessarily understand how they have what they have works, and they definitely don't know what it costs them. Now that gets their head spinning a little bit. And here's my hook. And this is what opens everything up to me, is I say, you know, Mr. and Mrs. Jones, if I did nothing more with our time today than show you exactly how what you have works and how much it costs you to own it, would that be a good use of our time today? And how many people are going to say no to that question? Because once then you are able to show them this, now you have everything that you need to know to be able to compare that to their current situation and to the opportunities that you can present for them in their portfolio. But I ask you, does cost really matter to people? Because cost in our industry isn't something that is all that well disclosed, which is why this DOL and this fiduciary standard and a lot of these things have been creating such drama in our industry. But I mean, does cost really matter? What about Geico? You know, Geico has made $1 gazillion over the last 15 years saying what? Well, we're going to save you 15% on car insurance. Well, I think about that and I said, okay, that's a pretty good marketing ad, and they got this cute lizard too. But I mean, what does the average American pay in car insurance each year? Well, the study says it's about $907 a year. So if we take 15% of $907, that's about $136 a year. So people are willing to change their insurance, go through the hassle of going through that whole process, take insurance away from their local trusted agent, the one that throws candy in the parade and hands out the magnets with the football schedule and is there when you get rear-ended to hold your hand through a claims process. They're willing to change away from a trusted agent like that for $136 a year and go to working with an 800 number of who's ever is answering that in whatever country. So I would tell you that cost does matter to clients, and I think Warren Buffett would agree with you, and he laughs all the way to the bank because obviously he owns Geico. So he understands that savings to people and understanding what costs are in any industry is important to people. And what about some of these other examples? Tom, do people go to Walmart for that client experience? I mean, are they there because Walmart provides them something that is just heartwarming to them? What about Costco? If you've ever walked through a parking lot of Costco and seen the cars that are in that parking lot, those people are our ideal clients, the type of people that we want to work with. There's a lot of beautiful new cars in Costco, and you walk around and look at those people in there. And those people are there paying $100 a year to be a member of Costco to save a couple bucks on toilet paper and rotisserie chickens, right? So cost is a big issue for people, whether they tell you that or not. And here's two more examples specifically to our industry. Vanguard and Scottrade. What has been their motto for the last 10 years. We're the cheapest game in town. And look at the amount of assets that they've been able to gather over the last 10 or 15 years. It's just staggering. So if you think about a 60-year-old, an upper middle class 60-year-old, their average portfolio, studies say their net worth is somewhere in the neighborhood of $2 million. So if somebody has $2 million, what is their total cost of management on a $2 million portfolio? And if you could save them 0.5% or 1% per year in their total cost of management, how much does that equal to? I mean, 1% is 20 grand. I mean, do they care about 20 grand? I mean, is that a real difference in their life? And I think it is. I mean, the Mr. may not care about that, but the Mrs. sure does, because, I mean, these people don't feel like they're rich. They don't act like they're rich. I mean, they're still probably clipping coupons, whether or not they have $1 million in their portfolio. So being able to show them this information really provides a lot of added value. So to complete what this AUM process means, first, add value. I mean, offer a risk and fee analysis. Mr. Jones and Mrs. Jones, if I could show you how risky your portfolio is and how much it costs you to own that on an annual basis, would that be of help? Because once they truly understand those expenses in their portfolio by using our proprietary database of 40,000 products to choose from, those products including variable annuities, mutual funds, index annuities, alternative investments, all these things that you can compare side by side, once you illuminate what their current situation is, it's pretty easy to make a compelling case for your products or services. So again, that fact finder, once you start to show them, Mr. Jones, here's how your American funds look. Your annual expenses are 1.3%. Here's how your variable annuity looks. With your rider, this, that, and the other thing, you're paying 3 or 4% per year in fees. With this managed account, you have mutual funds plus a wrap fee on top of it. You're paying 2.5% per year. Once you start to show them some of those examples, now they want to bring out all their statements and they want to show you everything, which makes filling out this fact finder really, really simple. So how can you do this? How can you show them this data that they need? And as Tom mentioned, I've been in the field for about 17, 18 years. And one of those things was having the data that I needed to be able to do these comparisons for people. And I woke up with the idea of not only being able to have all this data in one place, but then being able to document these transactions in a way that are going to keep us safe in this new crazy regulatory world that we're operating in. And that's what SwitchSafe has become for our advisors in the field. 5 key features of SwitchSafe that I think differentiates our system versus from anything else in the field is that, number one, we are the largest database of product information available in one place. Because we have over 40,000 different products in our system, and we have direct links to the prospectus going back about 20 years. And that includes variable annuities, index annuities, funds, ETFs, alternatives. So when that client comes into your office and they have a Mutual of Mississippi variable annuity from 1999 that you would know absolutely nothing about, how are you going to have an educated conversation with the client about that? Well, in our system, you can pull that up. It'll take about 7 seconds, and you'll have 73 pieces of information that you need on that variable annuity with all the fees, riders, expenses, and everything that goes along, which allows you to do, number 3, complete that side-by-side comparison of any of those type of products to illuminate the fees, costs, and features and compare, contrast those. But from there then is when the protection element really hits the road. And that's the documentation system that we've built to protect you from these frivolous complaints, arbitrations, lawsuits that we're seeing, and these big fines that Tom has mentioned in our introduction. And then finally, all this data in the system is wonderful, but if you don't have it with you wherever you're at, it's worthless. Locked away in the home office doesn't help us. So to be able to have this on your phone, on your laptop, on your computer, 24 hours a day, 7 days a week, wherever you're at, when you're filling out applications and those type of things, is where we're at in the 21st century, and we get this all done. You can visit our website, switch-safe.com, to look at more, ask more questions. Tom and his team is here to help as well. Tom, I think now might be a good chance to check in with you before we continue here.
Yeah, I haven't seen any questions, but if anybody's got any questions, there's a Q&A button, there's a chat button, and I'll be happy to relay them over to John. But John, I think you're doing a great job and some great sales ideas too. I mean, on how to really frame the conversation with the client to make it really a win-win.
Thanks, Tom. Technology is sometimes things that people get a little bit scared of, and especially some of our older clients. And there was a great article that just came out in Investment News a couple weeks ago by a guy by the name of Ron Carson. And if you haven't heard of Ron, he's been named an icon and innovator, one of the largest RIAs in the industry. And he has a coaching group, a lot of different things that he does, but he's a brilliant mind in our industry. And he came out with this article called "Technology Must Reinforce Trust or Else." And in it, I think it really illuminates what is going on in our industry. And it says here that our profession still struggles with a tainted reputation. 2016 poll by the American Association of Individual Investors revealed that 65% of the respondents said they mistrust the financial services industry to some degree. Clients walk through our doors every day with hesitation. There's nothing more powerful than helping your clients see the impact of their decisions through a little show and tell. Demand transparency of your firm, your team, and yourself, or your clients will beat you to the punch by choosing someone who can provide it. Now, think about that. Why are people hesitant to come into our offices? Because they've probably had a bad experience with somebody in the industry. And no offense, but most people in this industry all kind of look alike. They wear the same suits, and they drive the same cars, and they carry the same briefcase, and they talk in the same jargon. So people walk into our office and they don't really know who to trust. And are you going to be the same as the guy that gave me the bad advice later on? How can we prove ourselves to them on that first meeting to get them to trust us and open up? Ron continues and says, the best way to prove your loyalty to clients is reinforce that you have their best interests at heart by innovating your offering. They trust advisors who use technology to eliminate those doubts or concerns and showcase your value firsthand. Technology is so often used to hide something like the true presence of meaningful value. Advisors must understand that their clients crave doing business with brands that look out for their best interest. They adore firms that can demonstrate and deliver on those promises by sharing how their products and services continually evolve to better serve their clients' needs. Think about that. Think about the robo-advisors. Think about Amazon. Think about Facebook. Think about all these services that just make it easy for people to do comparisons and find out what the best price or this or that is, and they just trust it, and they just buy. And it's the same in our industry. And he says that trust is scarce, it's fragile, it's fluid, and it can't be controlled. Earning trust is job number one. Think about it. If they don't trust you, they're not doing business with you. It's our responsibility to find how technology can be used to reinforce trust, or we all run the risk of being destroyed completely. Put people at the center of what you do, use technology as an engine to prove it, and that trust will follow. Ron believes that in the next 5 to 10 years, people will be able to buy whatever financial product they want, probably directly from Google, Amazon, or Facebook. Why? Because those companies, those data companies, know everything about you before you even tell them, based on your buying habits, your search histories, those type of things online. So why are they going to need you and try to work with an advisor that they're already skeptical of, 65% of them, when they can just go out and do it their own online? And he's putting his money where his mouth is. He spent $52 million out of his pocket over the last 18 months to create technology, to create that trust and go through these processes with his clients as he's bringing them on. So I ask you, how can you use technology, and which technology is going to reinforce trust? And that's our system, our AUM system, the conversation the phrasing that I used early on. Let me show you how what you have works and what it costs. And I'll also show you how my stuff works and how much it costs. And now that you see that and have that transparency, it's really easy for you to understand and make choose solutions that are in your best interest. And that's what SwitchSafe is created for. And it allows you to do a transparent side-by-side comparison like this. You can compare 4, 5, 6 products at a time and show them, again, the cost, the features, how it all works. An example, you can compare a mutual fund, a Vanguard fund, a variable annuity, a non-traded REIT, and an index annuity all by side, and be able to show them the differences and the features and the cost structures of those type of products. And we're the only product on the market that allows you to do that with that breadth of products, that width of products. So as we move into these next 5 years, which are going to be a difficult time for us with the markets, think about who is your competition. What battles can you win, and what battles might you be losing? And how can you frame your business going forward? These are the type of things that I help with my advisors on a daily basis. And I say, well, let's think about Vanguard, right? If Vanguard is advertising that they're the cheapest out there, but they don't provide service, or they don't provide the hand-holding and the knowledge that you have, would it be possible for us to possibly beat Vanguard? And I look at this. This is the total bond market index fund. Now, they charge 5 basis points for this fund, so they are definitely cheap. But let's take a look at these 3-year returns. The last 3 years, they've returned 1.2%. 1.2. Do you think you have anything in your briefcase that might be able to beat 1.2% over the last 3 years? So how much money do they have sitting in this fund? Well, as of right now, they have $197 billion sitting in this fund. You think you might be able to provide a solution better than their $197 billion? Or what about their long-term bond index? This is going to get beat up even worse when the interest rates rise. They charge 15 basis points on this one. It's averaged about 2% over the last 3 years. They got another $10 billion sitting in this one. Do you think you could possibly beat that? Are you doing any marketing in your area to talk about comparing yourself to Vanguard? What about money market? Could you do anything better than a money market? They charge 11 basis points to manage money market. They got $93 billion sitting in money markets right now. So with all of your solutions, with all of your knowledge, with the heart that you care about these people, do you think you could help them reposition some of that $93 billion or the other money market cash and CDs that you have sitting in bank accounts right in your neighborhood banks? So I've created this slide to put in front of advisors, to put in front of clients, and ask them this simple question. You know, after we've seen this historic stock market run higher than we've ever been before, is now the time that you want to keep pushing your luck, or is it now time to start thinking about protecting your gains? And keep in mind, when we have a market correction, those fees that you're being charged on your portfolio are still being charged. So if the market goes down 20 and you're being charged 3%, you're going to see a negative 23 on your returns. Versus when it's been going up 20 and they've been taking the 3 out, you're still seeing 17. You know, that doesn't look so bad, maybe. But when the market turns, it's going to be compounded. And what plan do you have? How are we going to address this? Because notice, this volatility is starting to be back. Market's down 400 points as we talk today alone. So can you make sales? Have I given you anything today that gets your mind turning and where you might be able to make a sale? And hopefully I've been able to do that. But now what? So you go out and you make this sale, and what happens? Well, the regulatory world. You're dealing in a regulatory world that's crazy right now. And I ask, how long are you liable for your client's happiness with whatever they purchase? You see, just recently, this FINRA arbitration panel awarded an investor $1 million over what they're saying is a misleading sales pitch on a variable annuity. Now, the text you can read here, the client received far less than the 7% compounded annual return promised by the firm when she bought the variable annuity, according to her attorney. So this is an income rider that was sold on a variable annuity. And keep in mind, this is when the market's been going up. Market's been great the last 8 years, and she still was unhappy for some reason with the variable annuity that she was sold. Imagine what's going to happen when the market starts crashing. Scary times. But let's think about this. If this advisor did what they were supposed to and provided a prospectus, and the lady signed the application and added a rider, the rider didn't come standard, add a rider on it, then she gets a contract in the mail, has 10 days to free look it, accepts the contract, gets statements every quarter with a different value between the income rider and the cash value. And this contract was 7 years old. So she had 28 different monthly or quarterly statements with different values on it. But still 7 years later, they're able to come back and prove that, or prove to the arbitration panel that the advisor was misleading and got $1 million out of it. This scares the heck out of me as an advisor. And if you're not paying attention, I think you might get caught up in it too. Tom mentioned the incorrect data on replacement forms. I mean, it could cost you your career. What's your plan for that? MetLife was fined $25 million because they looked at 35,000 replacement forms and found that 72% of the time there were errors. Remember, your compliance officers have typically said about suitability, and they've always been looking at suitability guidelines for seniors or others that are purchasing different products and annuities. Well, guess what? FINRA understands that suitability is a big gray area, and you can argue one way or another real easily. But the difference between you on your replacement form, such as this, saying that Mississippi Mutual variable annuity that you were replacing, the rider charge being 75 basis points versus 50 basis points, that material misrepresentation on this replacement form makes it an incorrect data. And 72% of the time, these forms are not filled out correct in MetLife. And they have I worked at MetLife for a couple of years. They have one of the most scrubbing compliance department out there. Their NIGO rate is pretty high. So if they missed it 72% of the time, how many other firms are also missing it? And just recently, Fifth Third Securities, they were fined $4 million because they had a 77% error rate on these same forms. And this is part of my thought process when I created this system. Why don't we have all of this information at our fingertips? And SwitchSafe now gives you the data that you need to be able to pull up any product and within 5, 6, 7 seconds have everything that you need to be able to fill out not only the product that you know about, the one that you're selling, but the information for that product that you're replacing. So that alone should save you time, save your assistant time, and reduce your regulatory risk of having this bad error. Because ultimately, the regulators are being very aggressive, and they're looking to send a message. And this comes right from the Deputy Chief Counsel of Enforcement at FINRA. That's his quote directly out of the MetLife $25 million fine article. So how can we document a sale that 5, 6, 7 years later, they're not going to come back and win that you misrepresented it? First, you got to do the right thing, guys and gals. If you're out there not telling the whole truth or not illuminating all the facts of those products, you're just asking for problems. And truthfully, you probably shouldn't be in this industry. But if you're giving them all the right data and giving them the stuff that they need to know and giving them their prospectuses and walking through the fees and costs of the products that you're selling them, then we need to document it appropriately so you don't get lumped in with the bad guys when you're really a good guy. So we go through our documentation system that was developed with our team of securities attorney to document this the right way. So first we ask them specific questions. Are you acting in the best interest of the client? Because you should be. So confirm your loyalty. But then we're also asking the client to confirm their specific understanding of these features of the products that we discussed. So you're going to check off these specific things of whatever type of product that you're selling to verify that you explained it. And then the client makes an acknowledgement. I fully understand the above selected features. I'm of sound mind and knowledge to make this purchase, which I declare to be in my own best interest at this time. It's going to be a little harder for them 5, 6, 7 years later to come back and say, this wasn't in their best interest and they didn't understand it when they've just been able to sign this that a third grader could understand? It's not misleading in any way. What if you go through and you explain all those gotchas, all those things in a product that the client may not remember, those details later, the confusing stuff, such as that income rider that $1 million arbitration was over? What if they sign a box that says, I understand that any income rider that's added is not a cash value. It's unable to be taken out in the form of withdrawals. The income riders are only used to calculate an income benefit and not to be confused with a cash balance available for withdrawal. A different crediting rate will apply to income rider figures than to the cash value of your contract. That's third grade language. They can understand that. If they acknowledge this and sign this box, are you in a better position today than you were before you heard about SwitchSafe in your documentation? Would having a form like this in your file put you in a better standing? And I think you are probably shaking your head yes, and you should be using this type of documentation. How did you ultimately pick this product? Out of all of them that are out there, the client's going to confirm that they got the materials you gave them, the illustration, the fact sheet, the prospectus, whatever. But how did you end up getting to this product? There's a lot of choices. Why did you zone in here? And then ultimately, Tom, I think this was one of the big things that you mentioned was our documentation, and I call it 3 minutes to save 100 grand, because we go through and we ask you to tell the story of how the whole process, how you got there. And I phrase it like this: Mr. Jones, we've gone through a process and you've elected to purchase XYZ. The only problem is my compliance team has never sat in any of our meetings and they have to sign off on this purchase. So what we need to do is explain to them how we got here so they didn't think that I just walked in your front door and hit you over the head with a hammer and made you buy this product that you're signing for today. So we're just going to document this here. We're going to make sure that you and I are in agreement with this process, and then we're both going to sign off on this so our compliance team can approve this transaction. Again, now this is going to be agreed upon, signed, and you and your client are both signing on this, and it's much better than what your compliance officer has always said about, quote unquote, taking good meeting notes, because those meeting notes the client never attests to. And if you get into that arbitration scenario, it's your word against theirs, and if they've never signed those forms, now there's that potential argument. So I think this, again, is going to put you in a much better position and save you those legal fees of having to defend yourself in the future. And then ultimately, this all can be signed electronically. Tom, I'll turn this back over to you, and then we'll close and wrap this up.
Well, John, I think this has been incredible, and I think you and I both have. When last time we played golf, we talked about you had a friend that got in big trouble for doing something that the paperwork wasn't filled out properly. I had a friend up in Montana, been with the company 19 years, 6 months. He needed to just get to his 20-year mark to get a check for the rest of his life, and he got terminated because he put no surrender charges on a transfer form. It turned out there were some minor surrender charges. He'd never had a complaint in his life, and terminated. I mean, so this is serious stuff. And, I came out very much against that whole fiduciary standard because it was not in the best interest of clients. But I do think what you've come up with is in the best interest of clients, and it's a process. It doesn't matter if you use mutual funds or ETFs or managed money or annuities. As long as you're doing what's in the best interest of a client and you can document it and have an agreement with the client that they feel this is in the best interest of them as well, to me, this makes a lot more sense than that fiduciary standard that they were trying to push. So I think you've done a tremendous job here. I would encourage everybody again to just hit the text box or the Q&A box. And I'll be happy to relay any of that to John. He's going to wrap it up here, but we'll take another couple minutes at the end for questions. And again, if anybody didn't get an answer, because we're going to have this recorded, you can always send a question to info@tomhegna.com, and we'll get you the answer. And I think, John, you're going to share with them your contact information at the end as well. So why don't you go ahead and wrap up, and then we'll take some final questions if there are any.
Great. Thanks, Tom. I agree. I came out with in opposition of this DOL standard, this fiduciary standard, because I think it was just misguided about who is going to have regulatory authority in our industry. And I think it was a power grab more than it was to actually benefit clients in any way. Because if you're acting as a fiduciary, it isn't that difficult by definition. You know, you're just supposed to be doing what's in the best interest of the client. And most advisors out there are doing that anyway. And if they're not, they shouldn't be in the industry. They should be penalized for it. But if you're working in the best interest of your clients, which this is the fiduciary standard, you know, you're acting in undivided loyalty, you're not misleading, you're avoiding conflicts of interest, you're not stealing clients' assets for your own benefit, and you're providing full and fair disclosure of material facts defined as those which a reasonable investor would consider to be important, you're acting as a fiduciary. And our system was designed, and we've had broker-dealers that are using it and insurance companies that are using it to be able to use it to defend the DOL standard had that continued down the path, which thankfully it has not. But whether or not another law or another regulatory piece of legislation comes into play, we're already acting as a fiduciary, and we're using SwitchSafe to prove that we've done that. So this puts you in that trusted position, and you've done what you're supposed to. So when I built this from the ground up, as you've heard already, I've been in the industry 17 or 18 years. And this has been one of the big frustrations to me is the cost of everything in our industry. Every little tool is thousands of dollars, and I don't know if I'm going to use it once or twice or 100 times, or if it's really useful to me or not. So as an advisor, as I built this system, I wanted it to be user-friendly, super simple to use, be able to pull it up on your phone and do any of these comparisons in seconds. And then it needed to be priced right. It needed to be something that every advisor, Tom, I know you work with a lot of these big companies that have people that are just starting in the industry, and they may not have as much product knowledge as some of the veterans that are out there. And if they're just starting in this industry and they got a small budget, can everybody afford something? So that's where we price this. It's either $29 a month or $2.99 per year. It's less than $1 a day to have all this data to not only use our process with this data to win sales, which will quickly pay for itself, but also to use our documentation system to protect yourself should anything go sideways in the future. And again, I'm really concerned about what type of complaints, what type of arbitrations we're going to see when the market goes south. So use our system, protect ourselves. We do have a exclusive discount for Tom. Thank you, Tom, for making this available to your team out there in the field. We're saving you another $50 off. We're going to allow you to purchase an annual subscription for $250 through Tom. Simply send an email to us. You can see the email here at the bottom of the screen, john@switch-safe.com. And in your email subject line, just put Tom Hegna, and please include your name, your phone number, your company name, and your title in our email. That's what we need to create a user for you in our system. From there, we will send you, you'll have secured payment options where you can put your credit card in fully encrypted and protected to make that purchase at the Tom Hegna $250 price, the $50 savings. Also follow up with Tom's team if you forget how to get a hold of us. But we're here to help. We'll get you trained on how to use our system and how to best win sales out there in your practice. We have a series of YouTube videos, how to use it. But again, it's extremely user-friendly. If you can do a Google search, you can use our system, and we want to protect you and help you win sales. So with that, I'll turn it back over to Tom. Again, thank you so much. I've looked up to you for a long time. You've been a great mentor, a great friend to me and so many in our industry. I know a lot of us wouldn't have gotten here without you, and it's just been a real honor today to be asked to be here and share this with you and your team.
Hey, John, thank you so much. And we did record this, so this will be available. You will be sent a link to this sometime later today or first thing tomorrow. And please encourage others to listen to this, because I think it's been a great webinar. It wasn't just a compliance type webinar. It wasn't just a best interest type webinar. It also gave you some good language to use on your appointments. John, I don't see any questions or texts, but again, you've got John's email, john@switch-safe.com, and you've got info@tomhegna.com if you've got any questions. And again, this is recorded, and I want to thank you very much, John, for doing this for all my people today.
Thanks so much, everybody. We look forward to helping you in 2018, and good luck. Go out there and see the people, make them aware of the risks that they're facing, and help them before the markets catch up with them. You're very valuable. You can make a huge difference in these people's lives. So don't be afraid. Get out there, relate with them, use simple language that they can understand, and really help them. And again, thanks so much for your time, everyone. And thank you again, Tom, and your team for putting this together.
Thank you, John. And as of today, market's down about 350 points. So I think this is very timely, too, for everybody to start thinking this way. So thanks, John, and thank you all for attending today.